We have 200 basis points of rate cuts priced in through June of next year, with half of those coming before year end. Meanwhile, markets have priced in accelerating mid-double-digit earnings growth in 2025 at forward PE multiples in the ballpark of levels seen during the dot-com era. It seems as if the expectation is more for an immaculate landing rather than a soft one. So the question is, how does one reconcile that pace of rate cutting with the forward optimism? If the disinflationary momentum in the economy is demand-led, then corporates pushing margins any higher to substantiate these earnings estimates seems like a tough proposition. Our macro team's calling for growth slowing through the end of the year. Is this conditional set likely to amplify the downside asymmetry we typically get in a quad 4 environment?
The answer, Emma, is not blowing in the wind. The answer, my friend, is that's the old wall narrative, right? You want to have immaculate, soft, beautiful landings. You have to have your cake and be able to eat it too. You see, inflation has been solved for, but the best sector you can be long is real estate, which is inflating, which is going to impact come Q4 and into Q1 inflation numbers, CPI headline to the upside. So there are a whole bunch of issues to the client's question. To on the one hand, be begging for the Federal Reserve to cut interest rates by 200 basis points, you have to be fear-mongering or worrying the Fed about a recession. On the other hand, you want to take up your earnings for the coming quarters and into the next year. It doesn't make sense, right? That's why this morning, I don't know if you read it, Emma, but in the early look, I said, yeah, since I'm the most bullish person on Wall Street now, I'm going to start to write like a permable. Like it's a marketing job, right? Like you market to long only funds or people who wouldn't know otherwise, they'll pay you for it because they need talking points. So, I was obviously kidding because I'm not going to do that, but a permable would say no matter what growth and inflation and profits are doing, you got to be buying stocks, right? I mean, that's what Telecom Tom said. Like in 2021, you got to buy stocks because inflation is good for profits. In 2022, you got to buy stocks because disinflation is good for Fed rate cuts. It's like, dead wrong at specifically the right time not to be wrong. So this is going to be ongoing. I do think actually the earnings recession part of the question that we've been in is an easy comparison. So the way that I'd take this, if you take that slide, take slide 35, where you can see that by the first quarter of next year, never mind no recession, we actually have the economy both accelerating and inflation going up at the same time. So I think ultimately what they're going to do to take this question full circle, and if I haven't answered it full circle, please client can ask the question again in a different way or another part of the question because it was a long question, and I'm certainly not perfect in answering these questions. But what I think the market's telling you here is that they want to price in as many rate cuts as they can this year, so they can get paid this year. And then they'll deal with next year's narrative next year. There's no intellectual honesty with this, to be clear, from the old wall. This is just like, how do we get the Fed to print and stocks to go up? So they don't, again, we've had a very unique and accurate depiction of the economy. Again, not recessionary. We didn't think that the labor market would blow up in jobless claims terms north of 300,000 going into the election. Why? Because the government's been boring against your future to hire people. I mean, this is not wizardry. It's all in our. I guess I would call Steiner some sort of a wizard. But if you go into our slide deck, you can see all these different assumptions, which is quad 4, the monthly one, the big one to risk manage ahead of, has already been risk managed in July. Now I think you're risk managing it again into September. And then from there, inflation is going to start to go up in the fourth quarter. And then growth's going to potentially go up, not a lot, but in the first quarter. So there's a lot going on.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.